Well, good morning, or good afternoon, good evening, depending on where you're joining us from today. A very warm welcome to all of you. My name is Caroline. I'm Marketing Director at the Fry Group, and I'll be your host for today's webinar on the topic of passing wealth to the next generation. Now, a few points to note before we get started. We expect the webinar to run for about 1 hour, and during that time there will be some time allowed for your questions. So please do use the Q&A box, which you'll find either at the top or at the bottom of your screen as we go along, and type in your questions that you'd like to ask, and we'll try to get to as many of those as we possibly can towards the end of the session. If you miss any part of today's session, please don't worry. There will be a recording available on our website in the next few days, and you can also request a copy of the slides if you think you might find those useful afterwards. Okay, so inheritance tax is one of the biggest tax bills that most of us are likely to face. So it's important you take time to not just consider who you want to inherit your wealth, but how you can pass it on to them in the most tax efficient way. And that's what our team of experts are here today to discuss with you. So I'm joined today by my colleagues, Peter Webb, who's head of our tax advisory team, Shannon Brightman, she's trust executive, part of our estates team and headquarters in the UK, and Hugh Wedlock, he's the director of our Singapore operation and a financial planning expert. And the next hour or so, we're going to be discussing some of the proactive steps that you can take to safeguard your wealth for the next generation. Before I invite all of the panel to join us though, I'd like to first ask Peter to give us an overview of the problem. So Peter, tell us what actually is inheritance tax and how does it work?
There we go. All right. Thank you, Caroline. Just realised I needed to unmute myself. I think of inheritance tax as being the most punitive and pernicious weapon in HM Revenue's arsenal. In many cases, it's a further tax on income and gains that have already been taxed throughout your lives. If you're married or in a civil partnership and you leave all of your assets to your spouse, provided you share the same domicile status, and we'll touch on that later, there is no inheritance tax charged when you die. It's when the surviving spouse, the second one of you, dies and leaves your joint estate to your children, that's when inheritance tax is charged. And that can be at a whopping 40% on everything perhaps above 650,000 to £1 million. That's as much as you can probably shelter from inheritance tax. But when the second one of you passes away, anything above that could be in the frame for a 40% charge. So your resident status is assessed each year under the statutory residence test. Your resident status is not the same as your domicile status. Domicile is determined over the longer term, perhaps over your lifetime. So if you're UK domiciled, you're exposed to UK inheritance tax on your worldwide assets. But if you're not UK domiciled, you have a big advantage because UK inheritance tax is only charged on your UK assets. Your overseas assets are not within the scope of UK inheritance tax. Now, to make a very general comment, you usually acquire a domicile of origin from your father when you're born. It's hard, but it's not impossible to change perhaps a UK domicile of origin. So how can you reduce that 40% inheritance tax charge? So over the next few slides, I'm just going to give you some pointers. These are starting points, some of the simpler ways that you can begin to tackle that 40% exposure. First thing I'll say, spend your kids' inheritance. Your children won't thank you for that, but it's a really simple and effective way to reduce that 40% charge. Gifting. Gifts in life to intended beneficiaries, to your children perhaps. Gifting into trust, again, effective ways to get value out of your chargeable estate. There are some investments that you can make that can be exempt from inheritance tax after a certain holding period. Using insurance to fund a possible inheritance tax bill, that can be part of the plan as well. Okay. Now, if you share the same domicile status as your spouse, any gifts made between you, both in life and in death, are exempt from inheritance tax. Now, what you might want to do is gift assets between you if one of you is likely to live for longer and stands a better chance of surviving for long enough for a lifetime gift to a child to then be free of inheritance tax. So there can be reasons why you need to pass assets between spouses. However, if one of you is a UK person, a UK domicile, and they pass assets to a spouse who is perhaps not UK domiciled, the lifetime exemption for gifting from a UK domicile to a non-UK domicile is £325,000 only. You can give your non-UK domicile spouse more than that, but then conditions have to be met for lifetime gifting above £325,000 to be free of inheritance tax. There is some good advice to give you about that. Oh, I think I've gone one too far there. Let's just have a look. Okay, let's go back. Giving you a bit of a spoiler alert for what's coming, I think. Okay, all right. So gifts in life to other people. Making gifts to your intended beneficiaries, for example, children, during your lifetime, is perhaps the simplest and most effective way to reduce your inheritance tax bill. Hence the conversation, passing on wealth to the next generation. As long as you survive 7 years from making that gift, the value will not be charged to inheritance tax. And if you survive 3 years from making that outright gift with no strings attached, then the rate of inheritance tax begins to reduce and it gets to nil after 7 years. Downsides for doing that: you cannot retain any benefit in the asset you've gifted. You lose control of the asset that you've gifted, and there may be a tax cost for making that gift. Maybe it's a property that's going to be charged to capital gains tax when you gift it away. One of the more sophisticated solutions that we would use is perhaps, rather than make a direct gift to a beneficiary, you actually gift into trust instead. And you may be able to solve some of those downsides by doing that. Gifts out of income. Now, you are able to make gifts that are immediately exempt from inheritance tax without needing to wait that 7 years. Conditions need to be met. The gifts need to be made out of your income. They form part of your normal expenditure and are paid out on a regular basis. And making those regular recorded gifts out of your income should not impact your own standard of living. Now, this exemption is very valuable, but it does require good record keeping. What I like about this, it's very simple. You don't have to buy a financial product. You don't have to put assets into a trust. And if you wanted to, with just a brief conversation, it's something that you could set up this afternoon if you wanted to begin to tackle that 40% inheritance tax exposure. Okay, inheritance tax allowances. As an absolute minimum, what you need to be doing is ensuring you're using your annual inheritance tax allowances every year. And thinking about those gifts that you make, generally, when we look at gifts in contemplation of a marriage, the gift needs to be made, or at least promised, before the marriage or civil partnership actually takes place. But look at that slide, look at these exemptions. Don't miss the opportunity. These kinds of gifts are immediately exempt from inheritance tax without needing to wait 7 years. So when we think about the nil rate band, that's the amount that can be passed on without paying inheritance tax. And I've put the rate or the number up there for you. So you want to make absolutely sure that you are making full use of your inheritance tax nil rate band. So we're now moving into some really complex inheritance tax planning. Before we go any further with this, it's really important to say, with this particular domicile election, you do need to take specific advice for your own personal circumstances. Now, if you're UK domiciled, but your spouse is not UK domiciled, when you pass away, anything that you leave to your non-UK domiciled spouse above £325,000 could be charged to inheritance tax at 40%. So if you're UK domiciled and you leave everything to a UK domiciled spouse, or if you're non-UK domiciled and leave everything to a non-UK domiciled spouse, there is no limit to the amount that you can actually leave your spouse in terms of inheritance tax. There's no inheritance tax payable. What we're looking at here is a very specific situation where you have a UK domicile who is passing assets to a non-UK domicile spouse when they pass away. So everything above £325,000 in this circumstance could be charged at 40%. However, what that non-UK domicile spouse can do for this purpose is to elect to be UK domiciled. So then you have a UK domicile leaving assets to a UK domicile. There's no inheritance tax payable. The downside is that the receiving spouse is actually UK domiciled. They've elected to be so. So all of the assets then held in their hands, whether in the UK or outside of the UK, are within the charge to UK inheritance tax. It's an election that's irrevocable, but if you're a non-UK tax resident for more than 4 UK tax years, that election actually then falls away and a non-UK domicile status can reassert itself once again. Now, gifts to direct descendants when you pass away can benefit from an additional nil rate band of up to £175,000. Now, for a couple, that could actually increase your available inheritance tax allowances to £1 million. But this additional allowance is only available for the value of a property which has at some point been your private residence. And if your joint estate exceeds £2 million, then that additional bit, that additional £175,000 each, begins to be tapered away. Okay, a bit of a whistle-stop tour on inheritance tax. So thank you, Caroline.
Great, thank you very much, Peter. There's an awful lot to think about there. Let's try and tackle some of it now. I'd like to ask our panel now, if we can, to join us, and I'll stop sharing the slides. So Hugh and Shannon, if you could switch your cameras and microphones on, that would be great. Thank you. Let's get started. So let me start by asking a question for our estates team. So welcome, Shannon. I think we know it's important to have a will, but can you please tell us a little bit about what happens to your assets if you don't have a will in place, and perhaps touch on how a will can actually help you reduce your inheritance tax bill?
Yes, of course. Thank you, Caroline. So as Peter mentioned, we're only talking about this from a UK law perspective. So if you're domiciled outside the UK, then different rules will apply. So if you pass away in the UK and you haven't prepared a will, then essentially you have no say in how your assets would be distributed. So that in itself poses the obvious risk that potentially those that you wouldn't wish to inherit from your estate would do so. In addition to that, so when you pass away, your estate would pass in accordance with the rules of intestacy. It's actually quite common for those rules to be misinterpreted. So, for instance, if you have a spouse and a child or children, then the spouse isn't guaranteed to inherit your entire estate. So if your estate is over the sum of £270,000, then potentially your children will inherit, and that in itself could cause an inheritance tax liability. In addition to that, obviously, there's no guarantee that the main residence will then pass absolutely to your spouse. So the way to avoid that would be to make a will. We have testamentary freedom in the UK, so you can choose whoever you would like to benefit your estate, and that would avoid any nasty surprises on inheritance tax occurring. There's also a few other things that you can do in your will. So you can ensure, like Peter said, your main residence passes to your children in order to qualify for the additional nil rate band. You can also give 10% of your net estate to charity.
Great, thank you. Okay, so let's move on. What question for you now, Peter? Other than having a will in place, can you share with us some examples of other things you can do to reduce the amount of inheritance tax you pay? I know you touched on some of them, but perhaps you can go into those in a little more detail.
Yeah, for sure. I think I like to keep the plan as simple as possible. And I think one of the simplest things you can do is to make direct gifts to intended beneficiaries during your lifetime. So if you make that outright gift to perhaps a child during your lifetime and you survive 7 years from making that gift and you don't retain any benefit in the gift, and there are no strings attached, the child is then free to do whatever they want with that gift. You survive 7 years and the value of the gift that you make is then excluded from your inheritance tax charge. So if you think about that, maybe there's a property and it's worth £500,000. You make an outright gift of that property to a child during your lifetime. You survive 7 years and then you've saved £200,000 of inheritance tax. There are compelling reasons for making outright gifts during your lifetime. Now, there are some downsides to this. I think the first thing to say is you do lose control over the asset that you've actually gifted, so that child must be free to do whatever they want with it. There can be capital gains tax implications for perhaps gifting a property, for example. So residential property charged at 18% and 28% in terms of capital gains tax. And you do need to be ready to have you need to have the money to fund the capital gains tax bill because you've made a gift, you haven't received money in return. And I think perhaps most importantly, you need to consider when is the right time for a child to receive a really substantial gift, such as a house. I think sometimes that's why we think of more sophisticated planning using trusts. Perhaps it's more desirable to use a trust so that you can retain some control of those assets for longer. But at the same time, after 7 years, get them out of your estate. And at the same time, you can actually still retain some income from the property, from the investments that you've actually settled into trust. So I think those outright gifts to intended beneficiaries during your lifetime are absolutely great. We touched on making those regular recorded gifts out of your income. I think that's a fantastic idea because it stops wealth accumulating in your chargeable estate and allows you to pass wealth to the next generation in perhaps a much more managed way. I think another thing I would mention is do make sure that you are using your inheritance tax allowances every year. And when you get that opportunity to make a gift or marriage, just bear in mind those gifts aren't immediately exempt from inheritance tax without needing to wait 7 years.
Right, good, thank you. A couple of points there that I think we'll come back to later. The one about when's a good time to talk to your children, and also I want to talk a bit more about trusts. But before we move on to that, Hugh, can you, from a sort of financial planning perspective, can you add to what Peter's just covered? Like, are there any specific types of investment that can help with inheritance tax? And perhaps you can tell us a little bit about how they might work.
Yeah, so there are 3 sort of key areas to think about, really, and I'll just summarize those to start with. The first is insuring against an inheritance tax liability. The second is making a gift into trust, which we've already discussed somewhat. And the third is making investments into either unlisted shares or portfolios of shares that are listed on the alternative investments market or the AIM market. So I'll cover each of those in turn. Firstly, it is possible during your own lifetime to put an insurance policy in place that will generate some liquidity at the point that you do pass away. That liquidity then enables your beneficiaries to pay the resulting inheritance tax bill that is accrued, or that your estate has accrued on your death. Now, insuring against an inheritance tax liability does happen, and we do see it, but it's not hugely popular. And that's for two reasons. Firstly, it's quite expensive to insure someone's life on a whole of life basis. And secondly, no one really likes paying for something that they know that it's something that ultimately they are going to receive no benefit from. So we do see it, but it's not hugely popular. Probably the most popular one is the second one that I mentioned, which is gifting into trust. And the type of trust that you choose to use as the settler of that trust will really be driven by your requirements from the trust. So, for example, do you require any access to either capital from the trust once you've made the gift, or some income from that trust? Because the answer to that question will drive the recommendation that we make in terms of the type of trust that is suitable for you. Final thing to say on trust is that obviously once you have a trust in place, it's important to think about how much risk you want to take with regard to the management of the underlying assets. And you need to make sure that the portfolio is managed accordingly with your own attitude to risk as the settler of the trust. Finally, and talking about investments into certain types of unlisted shares or AIM listed shares, so shares that are listed on the alternative investment market, both unlisted shares and shares that are listed on AIM qualify for an HMRC relief called business relief. And that is quite a quick and effective relief for UK inheritance tax, because effectively, as soon as you make that investment, it's entirely outside of your estate 2 years from the point at which you've made it. So it's very quick and it's very effective. But as the names would suggest, there is a little bit of investment volatility involved in investing in both unlisted shares and those very small types of shares that are listed on the alternative investment market. Now, there's a few ways of reducing that diversification, and there's some packaged products out there that we can use from the perspective of certainly AIM portfolios. But it's another kind of very quick, not necessarily easy, but certainly a quick and effective way of mitigating UK inheritance tax. So just to summarize, really we're thinking about insuring against an inheritance tax liability, we're thinking about gifting into trust, and we're thinking about unlisted shares and investments into AIM portfolios.
Great, thank you, Hugh. So just following on from that, I think Peter and Hugh, you've both mentioned trusts in some detail. Shannon, can perhaps you add some comments to that? How can a trust in your will be used? And can perhaps you give us some real life examples of that?
Yeah, of course. So a trust is a way of managing assets. So whether that would be investments, land, or indeed buildings, so for your beneficiaries. And essentially what you're doing then is protecting those funds for them. There's lots of different types of trusts, and the tax treatment is different for each of them. Perhaps I'll just talk about the two common ones. So a life interest trust. So that is very common between spouses that have got second marriages. So the life tenant, which is usually the spouse, can receive the income that is generated from the trust, but the capital is then preserved for the survivor, although there is the option for the trustees to advance capital if they wish. So in a life interest, you can place a property or just a share in a property into a life interest. That means that the surviving spouse can continue living in that property, or they can move into another property if they wish. But upon their passing, which is usually the end of the trust period, then those assets are then protected and will pass to your chosen beneficiaries. I think a great example of where one of those trusts could have occurred was the famous Bruce Forsyth. He had an £11 million estate, and just for the simple reason he wanted to avoid paying tax, he left everything to his wife and absolutely nothing to his children. And I'm sure you could imagine they had a lot to say about that. So there was some things that he could have done to ensure that his children did benefit from his estate. Perhaps the other most popular type of trust is a discretionary trust. That gives the trustees more flexibility when deciding what to do with the assets and how best to control them. Very commonly used when beneficiaries are perhaps divorcing or they're going through bankruptcy proceedings. I'd say they're the two most common trusts, but I would just mention that trusts are extremely complicated, so it's vital that they're drafted correctly, and that obviously means we would suggest that you get professional advice.
Sure, got it, thank you. Okay, so Peter, back to you. You mentioned earlier on in your introduction that the amount of inheritance tax you pay is primarily based on your domicile status. Can you just explain that to us in a little bit more detail? And also, let's talk about if it's possible to change your domicile status.
Yeah, for sure. So everybody has a UK domicile status at every point in their lives. And that domicile status is usually, but not always, usually acquired from your father when you're born. Now, if you're UK domiciled, everything you have anywhere in the world is within the charge to UK inheritance tax. But if you're not UK domiciled, that liability to UK inheritance tax is simply limited to your UK assets only. Any assets that you hold outside of the UK are excluded from UK inheritance tax. I think it's really important to pause there and say it's excluded from UK inheritance tax, but please do have regard to any estate, inheritance or gift taxes that might be applicable in any other jurisdiction for you. Now, if you do have that UK domicile of origin, yes, it is possible to displace that UK domicile of origin with a domicile of choice overseas. And the reason that this is important is that if you can become non-UK domiciled by choice, then you are limiting your exposure to UK inheritance tax. It's a very, very high bar test to do this. You need to do two things. Firstly, you need to make it abundantly clear that you've left the UK for good, you no longer have any affection for the UK, and you can't foresee any circumstances whatsoever where you would ever live in the UK again. And on the other hand, the second part of this is, having turned your back on the UK, you actually have to choose another country, which is going to be your permanent home for the rest of your life. That's your stated intention, and you actually have to follow through with that stated intention. It's a very high bar test. There's lots of good advice to give you around this. You do need to speak to a professional to make absolutely sure that your argument that you've acquired a domicile of choice overseas would in fact stand up to scrutiny with HM Revenue and Customs. The difficulty with this is you can't get HM Revenue to agree this during your lifetime. It's only when you've passed away that this is tested. And of course, when you've passed away, you're not there to argue your corner. Just to give you a very familiar story, if you ever listen to me talk about inheritance tax, you think about Sir Richard Burton, one of our great actors. So he lived the last 25 years of his life in Switzerland. And he did that because he wanted to acquire a domicile of choice in Switzerland and make it clear that he'd turned his back on the UK, no longer had any affection for the UK. And there was, I think it was about £4 million that was at stake in terms of the inheritance tax bill. So what happened with Sir Richard Burton was that he was indeed buried in Switzerland. That's really important. But his coffin was actually draped with the Welsh flag, and the works of Dylan Thomas were actually tucked under his arm in the coffin. And HM Revenue extraordinarily were able to argue on that basis that actually he'd never lost his affection for the UK. And actually he was still UK domiciled despite 25 years of living in Switzerland. And they were actually able to charge UK inheritance tax on his worldwide estate. Thank you.
Ouch, thank you for that one. Okay, Hugh, question for you now. In your experience as a financial planner over the years, have you got some examples that you can share with us of like some real life examples of how we've been able to help families reduce their inheritance tax bill?
Yeah, I can think of plenty of scenarios. What I've tried to do though is think of the factors that are most common in those scenarios in terms of a successful inheritance tax mitigation strategy, if you like. Those kind of factors, if you like, are as follows. Firstly, I think it's really important for us as advisors to truly understand what the objectives of the individual or individuals are that are sat in front of us. So their objectives in terms of what is the quantum of estate that they're looking to mitigate tax on, and how highly motivated are they to achieve that mitigation goal. So we need to understand that. We also need to understand really effectively, as Peter's just said, what that individual's domicile position is. That's absolutely key before we start putting the strategy together. Second thing to say is that, as Peter's already said, the strategy itself is always going to be one or a mix of four things, and that is insurance, gifting, using all your reliefs and allowances, and spending some of your money. Those are the solutions, and for different individuals there will be a balance of those different things, and it's finding that right balance that's right for that individual and right for that family. And lastly, once you have that strategy in place, regularly review. That's absolutely key. Have regular touch points at which you can kind of gauge progress against the plan that you've put together with that individual. So I think those are the key points.
Lovely, thank you very much. Right, so let's coming back to a point that I think it was you, Peter, that started to touch on earlier. Talking to your family about what happens when you pass away, it's never going to be an easy thing to talk about. Shannon, perhaps you could share with us, in your experience, like, when should people begin a conversation with their families about their wishes?
Completely understand that money is probably one of the most difficult subjects, and families are often very reluctant to discuss their finances with each other. But from our experience, openness is definitely the best way forward. There's a way of managing your children's expectations of perhaps what they receive upon your passing, and not forgetting, obviously, emotions are already running high. It's an emotionally fraught situation. There's no nasty surprises for them to remember once you passed away. So we'd say it's never too early to start discussing your wills and your estate planning. If your children are younger, then maybe a way of going about it is, if they understand that you have an accountant or you have a financial advisor, then you can start talking about those sorts of subjects and approaching what those responsibilities are. Obviously, if they are younger, then you can obviously touch on the subject of guardians and who would look after them once they've passed away. Would also say that if you've appointed executors that aren't professionals, then you should let them know who drafted the will, where the original is being held, and obviously actually notify them that they are appointed as an executor.
Great, important points. Okay, so Peter, you explained earlier that one of the simplest ways, well, I think, and Hugh, you did as well, one of the simplest ways you can reduce your inheritance tax is to make gifts during your lifetime. When do you think is the right time for parents to begin a conversation with their children about receiving wealth from them and to prepare them for an inheritance? Hugh, can you perhaps share some thoughts based on your experience over the years with families of when is a good time for this?
Sure, yeah. So I think the first thing to say there is, when you're thinking about a trust planning in particular, a trust is a confidential document. So there's actually no obligation on the settlor or the trustees of a trust to disclose to the beneficiaries that trust is in existence. So there is a high level of confidentiality there if you require it. Having said all of that, I think in practical terms, whilst it's always good to have your children involved in the financial planning process fairly early in their lives, I think when you're thinking about talking specifically about inheritance and perhaps fairly large sums of money, really it's kind of mid-20s would be the point that I think it's a good idea to start really talking to your children about the mechanics of inheritance. Why is that? Well, a few reasons for that. I think in terms of the persons whose estate we're concerned with, potentially if your children are in their mid-20s, then you're getting to the point where you're beginning to think about estate planning and inheritance. You are probably at that sort of age. Your children can kind of cope with it at much better at that sort of age. You would hope that by the mid-20s they've reached a reasonable level of maturity and they can cope with that conversation about money. And finally, their responsibilities are growing. So when you're in your mid-20s, you're beginning to think about perhaps your first property purchase, and even your own family. So it makes sense, I think, for that to be the point at which serious conversations begin about estate planning. Final thing to say there is, I said earlier that kind of trusts are a confidential document and there's no liability on, well, there's no need for the trustees to sort of tell beneficiaries that they have a beneficial interest in a trust. It's obviously completely different if you're making a direct gift to someone. If you're going to do that during your own lifetime, you need to tell them and have a bit of a strategy in place there. So that's obviously final key point from my perspective. If it's a direct gift, obviously a bit more of a conversation needs to happen.
Great. Okay, thank you, Peter. I know you've worked with lots of families over the years in a whole range of circumstances. Can you perhaps share with us what are some of the most common mistakes that you see people make with their inheritance tax planning?
Yeah, goodness me, that's I wonder where you start with that one after 30 years working in tax. I think absolutely the most common mistake I see is that people make the assumption that if they do absolutely nothing, they won't have any tax to pay, and their intended beneficiaries are going to receive the assets that they want that they want them to. You do need to have wills to make sure your assets pass to your intended beneficiaries. And you do need to take professional advice to understand how much inheritance tax you're exposed to at the moment. And that is the starting point for any planning. I think one of the things I also see is people are in a little bit of denial about inheritance tax because it's not a nice thing to think about when you're thinking about when you're going to pass away. Real life story, last year somebody came to me and they were well into their 80s and they asked me to help them reduce a really significant inheritance tax bill. I'll try and put this as delicately as I can. The opportunity for them to make a really significant gift to their child and then survive 7 years, it wasn't really a realistic proposition for somebody in their late 80s. That they'd simply left it a little bit too long. There were things that we could do, but to be honest, it was all a little bit late in the day. Another thing I see really, really commonly is that people assume because they've been outside of the UK, maybe for living in Asia for 20, 25 years, that they must now have lost their UK domicile of origin. And they assume that because they've been outside of the UK for many years, that they've actually got a domicile of choice outside of the UK. That really isn't the case. And I have clients who've been overseas for 40 plus years, and they're still clearly UK domiciled. What else could we say? I think giving a significant gift to a child without thinking through the possible consequences of doing that. So perhaps you have a home, a family property that you want to gift to a child, and that child actually makes a bad marriage. And to fund a divorce settlement, they actually end up having to sell that family home that you've gifted to them. A completely unexpected consequence of making that significant gift to a child during a lifetime, which hasn't been that well thought through. I realise, seeing that family home, which may have been in the family for a couple of generations, and I've seen that, then suddenly it needs to be sold to fund a divorce settlement. It really does sound like a bit of a horror story, and we are close to Halloween, so perhaps it is. Yeah, those are I think the most common things I see.
Great. Now, as we've been talking, we've had lots of questions come in from our audience, which is fantastic. I think we should crack on and start getting through some of those. I'm going to start with a fairly short one. When does inheritance tax actually become due and need to be paid? Shannon, perhaps you can cover that one off for us?
Yeah, so inheritance tax will be due once you passed away, and it will be no later than the end of the 6th month after the person had died. So if, for example, you died mid-January, then the inheritance tax would be due by the 31st of July. If not, then HMRC will charge interest on the amount. There's different rules if you have inheritance tax, which is payable on property. But I won't go into too much detail because that's quite complicated.
Got it. Thank you. Anonymous question here in. What is the inheritance tax liability for joint tenancy property owned by a parent and a child? Peter?
Mm-hmm. Yeah, so that's actually quite a complicated question. I think that's likely one we would follow up individually. So yes, having a child as a joint owner of a property, maybe that can help. I think it's not always that beneficial to have a child as a joint owner of a property with parents, for example. Yeah, in terms of the overall inheritance tax exposure, you just need to look at the overall asset base and understand what that exposure is to then come up with that plan, perhaps to pass on the value in a property to a child. We can certainly look at the numbers for you. What I would say is there are some really strong contraindications for actually having a child named on the deeds of a property, because as parents, if you have a child on the deed, actually technically you're not allowed to sell that property without the child's permission. And if you wanted to refinance, you wanted a new mortgage on the property, again, you would need the child's permission to do that. And also go back to that case of perhaps a child's made a bad marriage and that they're divorcing, and perhaps a departing spouse would have a claim on their assets, and that would actually include the value of the property that they have their names on the deed of. So I think there is some really careful advice to give around that.
Okay, well, stay there. Don't mute yourself because there's quite a few questions I think are coming your way, Peter. Peter, you mentioned that you can make a gift from income to achieve no inheritance tax if you live past 7 years. Besides salary income, does this include income from investments or interest income? Okay,
so if you make that regular recorded gift out of your genuinely spare income, you don't have to wait 7 years for that to be exempt from inheritance tax. It's immediately exempt. And the key word there, I think one of the key words is income. So that would include employment income, that would include pension income, that would include dividends, it would include interest. What it wouldn't include is if you actually have to sell assets to fund that regular gifting that you're making. I think it's a very, very valuable relief to mention, because what I really like about it, it's really simple and straightforward. There's some great guidance out there. If you look at one of the IHT forms, I think it's the IHT 403, Shannon will put me right if I've got that one wrong. But actually at the back of that form, which you can download from the internet, it actually gives you a schedule so you can record your regular recorded gifts out of your genuinely spare income.
Right, great. I'm going to give you a short rest, Peter. I think I am. Hugh, I think this is one for you. What are some sort of typical indicative costs of a trust?
So it depends on the underlying investment that we use. On the whole, I know Shannon sort of referred to kind of putting together a bespoke trust deed earlier in the earlier in the discussion. A bespoke trust document is a document with a lot of kind of work going into it, and that will be a reasonably costly exercise to put that together. And you might also be paying some trustees to manage the assets within on an annual basis as well. To be honest, though, on the financial planning side, we don't tend to use genuinely bespoke trust deeds very often. We tend to use trust deeds that are kind of more off the shelf, which we can get either from a product provider or a life insurer. And on the whole, there is no additional cost to those trust deeds over and above the underlying investments that are sat in the trust. So, generally, for an off-the-shelf type of trust, the additional cost over and above the normal sort of cost of investing is not very high.
Got it, right.
Negligible.
Peter, back to you for a couple of questions here. This is a good one. So if I pay my grandson's hall of residence costs directly to the university, does this count as disposal of my assets or a gift to my grandson?
Okay, that's a really, really interesting question. Yeah, it likely would be a regular gift out of your income or a disposal of assets. Actually, do you know what? I'm not absolutely sure on that. Shannon, do you have a view on that?
Sorry, Peter, could you just repeat that for me?
Yeah, so what we have is money that's being paid to a hall of residence rather than a grandchild. So is it actually just normal expenditure, which immediately reduces the estate, or is it a regular gift out of income? Actually, I've taught my way around this one because both work. So it's just exempt from inheritance tax immediately, whichever way you look at that, I think, Shannon. Do you agree?
Yeah, I do agree, and I think the best option is to pay it directly to the university or the residence, like they said, rather than to the grandchild.
Great, thanks, Shannon. Got me out of trouble. Thank you.
Got there in the end. If a child is a beneficiary of a trust and gets divorced, is the benefit from the trust caught up in the divorce settlement? I don't know if Peter or Shannon, best place.
I'm happy to make a comment on that.
Yeah.
So if you're looking at the UK and you're looking at divorce, you can have structures in place that try and protect assets, but UK family courts are notorious for actually looking through those structures. And so you can have all of the structures, you can have a prenuptial agreement in place, but actually the courts will actually look straight through that and take a view on what assets you're actually entitled to and make their judgment on the split of assets accordingly. So it could well be the case that actually assets in a trust could be included in that divorce settlement. There's some real care needed with that, and I think you would need to take some really careful legal advice.
Got it. Okay. Let me see, where should we go next? Here's a good one, I think, probably for Shannon. If you make a new will in the UK, can it revoke a previous will made whilst resident in another country?
So if you've made a will in a separate jurisdiction, then you need to ensure that one will doesn't revoke the other. So there should be a limitation of effect. When you've made your will in your country of domicile, that would deal with your worldwide assets and exclude that country. And then the country that you've made the separate will in should just deal with those assets solely.
So if you're UK domiciled, you've written a will in the UK, but then you've also got a will in another country, the UK will take the priority.
So they should work alongside each other, but that depends on how the will has been drafted. So they need to be drafted correctly and have the correct wording to ensure that they will both still work.
Got it. Okay, thank you. Okay. You've talked about passing gifts in life to children. Is the tax situation the same if the gifts in life are made to other people?
Yes. when we're looking at making a gift, what we're looking at is likely either you making a gift of an asset, so perhaps a property or some shares, or actually perhaps disposing of an asset yourself and passing on cash. In any event, you do need to be mindful of the UK capital gains tax implications for making that disposal. If you gift the asset, that's a disposal for UK capital gains tax. Or if you sell the asset to give cash, you've also disposed of the asset and it's chargeable to capital gains tax. I think property is the one that perhaps is the most challenging there, because if, for example, you gift a property to a child or to somebody else, then you actually have to report that within 30 days to HM Revenue, and you have to pay any capital gains tax due within 30 days as well. And the challenge there is if you've made a gift, you've not received any money in return, and you may not be able to fund that capital gains tax bill. So that really does need to be thought through very carefully. But the answer to the question is, if it's a gift, whether it's to a child or whether it's to your own child or to somebody else, yes, that is going to be charged to capital gains tax depending on the asset.
Great. Okay, here's another good question. So if I'm UK domiciled and receive an inheritance from somebody outside of the UK, is there any UK inheritance tax due?
Shall I pick that one up? Yeah.
Go for it.
The receipt in and of itself of a legacy, whether that's from in the UK or outside of the UK, the receipt of that money does not in itself provoke any kind of inheritance tax charge immediately. It doesn't need to be reported on your tax return. There's no income tax and there's no capital gains tax. However, what you need to be mindful of is that legacy, that inheritance you've received, is then going to be included in perhaps your chargeable estate. So you then need to consider, do I have a plan to reduce the inheritance tax that I might pay on that later on? And also you need to think about how you're going to invest that legacy that you've received, because although there's no reporting or tax on receiving the legacy, what you then go on and do with that money that you've received can then provoke its own income tax and capital gains tax charges.
Okay, thank you. Does the nil rate band apply to each person inheriting? For example, if two children inherit at the estate, does each child have the full allowance?
Should I pick that one up again?
Yeah, sorry, no rest for you today.
No rest for me today. Okay, so that nil rate band, it's not like in the UK, I know there are jurisdictions where you have a gift tax and each of the beneficiaries has their own allowance for receiving something from parents. In the UK, it's different. That nil rate band actually applies to the parent who's passed away, using the example of a family. So if you have two parents, let's talk this through. You've got two parents. So you've got the first spouse dies, they leave everything to the second spouse. So that first spouse had a £325,000 nil rate band. And if they didn't need to use it and everything passes to the surviving spouse, that surviving spouse then has their own nil rate band and the unused nil rate band from the first spouse who passed away. That then gives them an overall exemption of £650,000. So anything they leave to children above £650,000, that'll be charged to inheritance tax at 40%. What happens is the executors of the estate will actually pay that inheritance tax over to HM Revenue and Customs first, before they pass on the legacy to the children.
Okay. Sorry, Peter, please stay there. Can I gift a property into trust during my lifetime without incurring capital gains tax?
No, the property, trusts, inheritance tax, capital gains tax, this is a bit of a disaster. We've talked about, Halloween and horror stories. This is definitely it. That there may be ways, if it's not a residential property, that you could try and do this. There may be a way to actually hold over the gain, but it's very, very difficult to do. And holding a property in trust in and of itself is not going to exempt that property from inheritance tax. It might possibly delay the inheritance tax. What you need to be really careful of with putting property into a trust is taking really good advice about this, because there can actually be a 20% inheritance tax charge for getting a property into a trust, leave alone the capital gains tax implications of doing this. When that property comes out of trust, there can be inheritance tax charges then, and there can be capital gains tax charges too. There is some really careful and detailed advice that's needed. UK property into UK trusts it's very, very hard to do in any kind of way that's tax efficient. I'll leave it as a simple summary like that.
Very good. Okay, well, we're sort of getting towards the end of our time now. But before we finish up, I think I'd like to ask each of our panelists, can you think about and give us your just one top tip? What's your top inheritance tax planning tip to leave everybody with today? Shannon, do you want to kick that one off?
Mine would be to seek professional advice. I know some people do think that they can solve these problems themselves, for example, draft a will yourself. That's not always the case. There's always pitfalls that you never consider. And if you don't seek legal advice, then you're risking those things happening. Great.
Hugh?
So my thought on that was to start early. Inheritance tax is not a voluntary tax by any stretch, but the more time that you have to plan for that tax, the more voluntary it becomes, if you like, and the better you can mitigate the end result.
Great, thank you very much. And Peter, final word.
Yeah, I think I would echo Hugh and Shannon on this. I think the first thing to do is to understand the problem. Speak to somebody, work out what that inheritance tax exposure is, because it could be the case that there's a really simple action that you could take that would reduce your exposure to inheritance tax.
Great, thank you very much to all of you. Peter, actually I said that was the final thought, but one final thought before we go. The autumn budget, I think it's just a matter of hours, maybe even minutes away. Any thoughts on whether we're likely to see any changes to IHT?
I think it'll be a case of tax another day. I think there may be consultations that are announced, particularly around perhaps an online sales tax, for example, but inheritance tax, I don't think that's going to be touched this time, but I do think that inheritance tax and capital gains tax are the low-hanging fruit, and in terms of repaying the COVID bill in later years, I think we're going to see significant amendments to both of those taxes.
Okay, well, let's see. Not too long to wait. So thank you very much to all of our panelists for your help today and for answering some of those questions. I know that many of you are familiar with the Fry Group, but just very, very briefly for those of you who are not, we're a 123-year-old business. We've been providing tax, estate and financial planning advice throughout our 8 offices around the world. Our core purpose is to help people, whether that's our team, our clients, or people in the communities that we operate in, to help them achieve their financial freedom. And if we can help you with your tax, estates, or financial planning needs, or if you have questions from today that we didn't manage to answer from you, we would love to hear from you. Please do get in touch. That just leaves me to say thank you once again to Peter, to Hugh, and to Shannon. And most of all, big thank you to all of you, our audience, and for all the fantastic questions that you've asked. And we hope to see you again sometime soon.